Not sure if the scheduled streams are catching on with Restream, but we are live right now. Welcome everybody to Culture Shock University, owner of Culture Shock Investments here with you, Michael Clark. And this week we are going over stock market personalities because if you're in the market and you trade, you know the stock market has many personalities, or it could seem like it has many personalities or split personalities. And we're going to go over the main ones that you're going to experience, and actually the only ones you truly experience, even though it may feel like more conditions than that. All right, I want to give people time to join. Let me get the Discord started, the class started in here, and we will get on the way. Get that started. Wow, wow. Class is now live at everyone. Make sure if you're here in the chat, make sure you type in your questions in the chat. If you have any questions during the class, I will get to your questions at the end. I may not get to them at the during the presentation, but I will make sure to get to those questions in the end, okay? So type your questions in the comments in YouTube. If you're on YouTube and Discord, do the same thing. And on TikTok, because we are live on all three platforms. Culture Shock Investments on every platform. Make sure you're following us today. If you're not, big mistake, because you're missing out on a lot of great content, a lot of profits that come through some of these call outs we do in our live community, as well as the price levels that are provided. But if you're following us on social media and YouTube, you are getting a lot of this free educational content. That's what's going down for you, okay? Give people a couple more seconds to join. Make sure my stream is looking good on the platforms, because last time it was tripping. Okay. Looks like we're looking good right now. Let's see, TikTok. Gonna get this class started at 7:05. Get people till 7:05 to join. You know, say 7 o'clock. No one's ever right on time, so gonna give them to 7:05 to join. Make sure you are getting your notepads ready. Ask any questions you really have about options trading. Doesn't have to be related just to this class. I'll try to answer any questions you may have, any place you may be stuck in your learning. I may have a class that is already prepared for you that you have not seen yet. Definitely go to the Culture Shock University course on YouTube that we have. It's in a course format now. I love that YouTube did that, because they know a lot of people are educating on their platform now. They call it YouTube University. A lot of people learn on this internet platform. A lot of people are not going to formal universities and classes anymore. And there are a lot of people out here who are teaching, who are licensed teachers and who are licensed in their professions like me, and who are looking to give you the education on what is going on in the stock market. All right. You have people that are out here just looking to share their knowledge and give you advice and guidance, and leaving it up to you to do deeper research. You know, I have certain topics I speak on, and I'll tell you on those topics as well that, this is not my area of expertise, but this is what I know. And always consult with a professional when you're looking in these areas. But all right. I think we got a couple people joining in. So I want to go ahead and get this class started. I want to say thank you and welcome to everybody who is here in the stream. I am Michael Clark, owner of Culture Shock Investments, and I will be your teacher for today. Okay. We're going to go over the personalities of the stock market, the different stock market personalities that exist. And these exist because of the different these exist because of the different attitudes and conditions that the market is placed under. So we have a lot of things that's going on in the world when it comes to geopolitics with Iran, with Trump being president, or if it's Biden being president, or if it's Bush, or whatever the conditions are, whether we're in war, whether we have a coronavirus situation going on, the stock market is going to take on a certain type of personality, okay? And that personality is going to tell you how you need to trade the market. You don't go in with the emotion of what you feel in that moment, whether that be a war, whether that be the pandemic, whether that be whether that be a some kind of geopolitic event that's unforeseen. Those are can cause emotional reactions, and that's where a lot of people get caught up and lose money in the market by getting emotionally tugged and pulled in those moments. All right, so you don't want to emotionally react. You want to go ahead and react to what the market is telling you, what the market personality is telling you, because sometimes, believe it or not, how you believe the market should react is not how the market reacts in all scenarios. There's times and cases been in the past where when I first started trading and investing, I didn't understand the correlation between how people losing jobs could help a stock go up in price. But those two things play off of each other. So a good economy doesn't necessarily mean a good stock market all the time. Sometimes people feel like a bad economy can lead to a good stock market. So high unemployment, high inflation can sometimes leads to favorable conditions in the stock market so people can make money through that volatility or through the increase in income that the company may have through laying off employees. So they lay off 10,000 employees. That means on their next earnings report, they're going to show that much more money in profits or $20 more million in profits on their books because they don't have to pay those employees and they're still being just as efficient as they was last quarter. That's a good thing for stockholders. They were rewarded for that. But in the real world, you'll see that as a bad scenario because people were laid off and they lost their jobs. All right, so these are the things that you got to understand, the correlations and the personalities that the stock market will take on, and you cannot predict it in advance, but you do want to know how to react when you do see it happening, okay? Because when it happens, you will recognize it. So let's get moving. Every market has a personality. Just like everything has a personality, you and I have a personality, animals have personalities, the market has a personality. There are only four things the stock market can do. It can go up, go down, go sideways, or it can become extremely volatile. Okay? Extremely volatile means it's going up and down in a wide range. It just keeps chopping all over the place. It's not holding in any one particular area or going in consistently in any one direction. Every option strategy is built around one of these four expectations, okay? So even though you may feel like there's 1,000 things that the market can do and 1,000 different personalities that the market may have, it really is only four things that the market is doing at any given time. It's either going up, going down, going sideways, or it's being very volatile when it's going up and down in wide ranges, okay? Once you identify the market environment, it makes it much easier to choose a strategy because the strategies are almost laid out, pretty much laid out for you for each condition. And we're going to go over each of those strategies today. So the four market environments, you have a bullish market environment. A bullish market environment is when you consistently see higher highs on your chart and higher lows. So when you're looking at a stock chart, you want to see the market consistently produce higher highs and higher lows. And a good example of that was when you look at some of the ETFs over the long term, okay? So you could look at ETFs on a long-term chart. I'm going to give you an example right now of of the QQQ over the course of a 3-month chart. Okay, so let's go ahead. I'm gonna pop this up on your screen really quick. Let's pop this up. So this is a QQQ chart, right? This chart right here. So when it says bullish patterns, it's saying higher highs and higher lows, right? When you're looking at each one of these candlesticks, when it's talking about the higher highs, it's talking about the high point of these candlesticks if they keep getting higher than each other. You don't want to see these highs becoming lower than each other. That's a lower high. So right here, back in July 2018, the QQQ is trading at $185, right? So let's just start from marking this level. $185. Then, actually, let's cut it off. Let's do it like this. $185, right? Then it came down to $140. So that was the low that it made. But then it made a higher high because if we went above $185, we made a higher high here at $216. But it came back down, right? Where did it come back down to though? 164. That's a higher low. That's higher than the previous low of $140. So this is showing continuing strength. In the next high, we got a higher high. It kept going higher. We got a higher high on the next stop. It stopped all the way up there at $406. And then it came back down to 254. Okay? So this is a condition that you're going to see. That's the trend of you're going to see in the pattern you want to look for in a bullish pattern. Something that's doing this kind of pattern right here. That is considered a bullish trend. All right, we're going to go over a couple more of those patterns throughout the class so you guys can see it live on the charts and understand what you're going to be looking for in each of these. So, a bearish condition will be the opposite, lower highs and lower lows. So, you can profit in these conditions from downward movement. In the other condition, the bullish market, you're going to profit in that market from the upward movement. So, we're going to do option contracts like calls, call spreads, and debit spreads and things like that that are going to allow us to profit from the upward movement. In a bearish market, we need to do puts. We need to do things like bearish put debit spreads that are going to give us profit on downward movement on the stocks, because in the stock market you can make money on stocks going up or down. That's the beautiful thing about the stock market, and you can amplify those gains with options. Neutral. Neutral is range bound movement. It's because this is going sideways. When the stock is not really going anywhere, it's going sideways. It's chopping. So that is going to be range bound movement. This is where you could collect premium while it stays within the range that you've identified. As long as it stays within that range, you're going to collect your premium. You're going to collect your profit. That's what premium is, okay? High volatility, large expected moves. So this is when you expect the stock to either go up by a lot or down by a lot. You don't expect it to necessarily stay sideways. You don't expect it to go up in a consistent pattern or down in a consistent pattern. You just know a big move is about to happen, either up or down. So you're trading the volatility rather than the direction. And there are strategies that allow you to trade those volatility conditions. And it doesn't really matter if the stock goes up or down. As long as it makes a big move, you are making money either way, okay? And that's trading volatility. Let me show you a quick example here of a stock that has been, or something that's showing a downtrend, all right? We got our chart of Oklo right here. This is a funny example. Oklo is showing you right here, identifying a downtrend. As you see, the stock, it ran all the way up. We're going to say we're going to start from right here at $169. And then it came down. Oh, okay. These are all these levels I have on here. I'm sorry. So it came down from $160. It came down to $96. And then it tried to come back up and went back up to $118. So that's nowhere near the previous high of 169. I let you know we're making a lower high. And then the next low it made was at $77. So that's lower than the low we made here at 96. So I let you know, we're getting a bearish trend. It's starting to form, okay? So that's what a bearish trend will look like, and that's what you're looking for when you're looking to make money to the downside, to see a trend like that, and you're going to ride that trend until it shows you otherwise. A lot of the times people will see this trend and they'll try to time and get the reverse back to the upside and catch it going back up. And what will happen is you're fighting the trend now. Now you're trying to tell the market what to do instead of you listening to what the market is saying. And one thing I'll tell you the market doesn't do, the market does not listen to you. So don't ever think you're going to come into the stock market and tell it what to do. All right. The stock market is not going to listen to you. It's going to do what it wants to do. And it's going to tell you what it's going to do. And if you choose to refuse to listen, you will continue to lose money, and it will take your money without regret. Cold blooded. I promise you. You won't. It won't say sorry. You won't say damn. I try to warn you. Anything. It just take your money. So don't let it do that to you. Don't be stubborn. Don't be hard headed. Listen to the market, or it will break you. You're not dictating the market. The market is already doing what it's doing. You're just here to make money off of these trends. And I'm going to show you exactly how to do that. So, like I said, we identified a downtrend here. Let's get back to the slides. A neutral trend is going to be pretty much going sideways on high volatility. I can give you guys an example of high volatility. Give me a second. Let me show you something with high volatility. Let's pull up Tesla. Everybody likes Tesla, right? Tesla is a pretty volatile stock. High volatility. So let me show you what that means. So this is over, let's say, a 3-year span from 2023 to 2026, right? In this time span, Tesla has gone up 160%. It has come down 55%. It has gone back up 124%. It has come back down 30%. That's very high volatility. You don't really see stocks move in that kind of wide range, especially within a 1-year span. This is pretty much over the course of 2 years. You don't really get that kind of movement in stocks that have strong uptrends or they're holding stability, because they won't give out certain support levels so easily. So this is a high volatility stock. And this is where you could trade a stock that you could trade a range on, because you identify Tesla as being high volatility. So you could find certain events such as these E's. You see these E's on the chart? These are the earning events. These are earning reports, right? So some people choose to trade the earning reports and say Tesla's either going to go up a lot after earnings, like it did right here. After this earnings report, you see it had a little dip, but then it shot up within the next next 2 months. It shot up before the next earnings report. And then you have instances where you have an earnings report, and like this one right here, and it shoots down. Now, because you know Tesla's going to give you a big reaction after earnings from its current price, you could take a trade to the upside and downside, and at higher out the money contracts that allow you to take advantage of making money if it goes either direction. But that's a strategy that is a little more advanced, and that's a collar trade, and that is also called a straddle or strangle. I haven't gone over those strategies with you yet, but that's just a quick, brief example of how that will work, so you're not lost when I say straddle and strangle later on in the lessons, okay? So let's get back to it. The strategy selection matrix. I put this together for you guys so you understand what you want to look for in each condition of the market, okay? This is a beautiful template right here. You can screenshot this, save it, so you understand what to do. Have it next to you when you're trading, so you understand what you're looking for in the stock market, and understand what strategy you need to implement when you are seeing certain kind of activity happen in the market, okay? So you want to make sure that you screenshot this. Don't let it go by you. I'm going to leave it up here for a second. So with stock rising aggressively, you want to buy calls. Why do you want to buy calls? Because, like we said, we see the stock rising aggressively. That's an aggressive uptrend. Stock rising moderately. That's the call spread. We went over call spreads. So that gives you a cushion to the downside, but it also caps your gains to the upside. So you don't have a belief that the stock will rise aggressively, but you do believe it's going to go up. That will be your call spread. When the stock will rise slightly, you could do the bull puts credit spread. That's another strategy that limits your gains, but it also gives you a range to trade within without you taking any kind of dramatic loss on the stock pulling back, if it does pull back, because you're not that confident in the stock rising, but you do believe it will rise slightly. which gives you a higher chance for a pullback. The higher chance you feel for the stock going in the opposite direction of what you feel, the more insurance you need to put on. Okay, so buying calls is like buying a naked call. You're going in there raw and you're saying, you know what, I believe in this, I trust this, I have no doubt that the stock is about to go up. I see the pattern, I see the trends. I'm just going to buy a call. That's when you do that. Okay, and that is no insurance behind you. So if the stock goes down, you're going to lose your money very quickly. A buy and a bull call spread, you believe in moderate raise, so you're going to be favoring the bullish move. But if it pulls back, you won't take as big of a loss as you would if you just took a straight up call in that same time frame. All right, and buying rise if you believe the stock will rise slightly, that credit spread is giving you even more insurance and protection. But all of these, as you get more insurance and protection, of course, limits your gains to the upside. This contract right here is going to give you unlimited upside potential. If the stock just pushes up $50 or $100, you're going to make all those profits with the regular naked call. Okay, and the same thing on the opposite side with the puts. If you're buying a put, this means you believe the stock will fall aggressively. If you believe stocks will fall moderately, you're buying that bear put spread we talked about and that strategy we went over already. And if you believe the stock will stay sideways, that's the last and most recent lesson we went over. That's the iron condor strategy. I believe I may have to re-record that. I think that one was getting glitched out. So I'm gonna put that back up for you guys. But the iron condors for the sideways consolidating stocks, you could really collect some good premium on those. Don't sleep on the iron condor because the iron condor will make you money on those stocks that really have no price movement. And believe it or not, there are a lot of stocks out there. When you look at their chart history, they're actually going sideways because they're built to do that. So those are stocks that you can really make premium on weekly by putting iron condors. You don't want to do it on things like the SPY and the Qs that are consistently going up or having volatility moments of volatility. You want to find those stocks that have been trading within the same price range for like the last 2-3 years. Okay, they haven't moved outside of this maybe $5 to $10 price range in the last 3-4 years. So you could find good iron condors on those. It's not going to be high premiums, but you could collect a little bit of money every week. And depending on how much money you have to put into them, you collect even more premium. So 5% on $1,000 doesn't seem like that much, but 5% on $100,000, if you could collect that every week, I'm pretty sure that's a nice little form of income for people right there. Let's keep it moving, y'all. Volatility determines everything. When you're in option trading and when you're investing, volatility is going to determine everything. This is one of the biggest mistakes beginners make when investing. They get caught up in emotions and not paying attention to what the market is actually telling them. All right. You do not want to ignore volatility. You don't want to ignore low volatility conditions or high volatility conditions. Okay. So let's go over this. Low volatility conditions, option contracts tend to be cheaper. Buying options become more attractive because those contracts are cheaper. All right. The strategies you can implement in these conditions, you can implement long calls because you're able to get contracts at low premiums due to the low volatility. Long puts, the same thing. Debit spreads that we talked about. Vol I'm going to say it again. One of the biggest mistakes beginners make is ignoring volatility. How do you find volatility? You can spot volatility using something called the VIX. We use the VIX to identify volatility, okay? And there's a VIX chart. The VIX index will give you the current level of volatility within the stock market. And you could determine how you need to be trading based on where this level is at the time. So let me show you the VIX chart. This is the chart of the VIX right here. And you see at certain times, the VIX tends to spike. In these moments of spiking, there's usually something crazy going on in the market and the stocks are pulling back. When volatility is calm or lower than this baseline right here, about let's say 18, then that means market conditions are really good. So when you see the VIX down here at 15, 14, 13, 12, market conditions are usually really good at those times, okay? So you could see and you could go back and look at the VIX chart and compare it to what was going on in the stocks at that time, and you'll see a lot of the stocks are reacting to this chart. This is pegged to the S&P 500, so this is telling you the amount of volatility in those 500 companies, but those are the 500 major companies that people trade and invest in globally. So if they are getting more volatile, usually the entire market is feeling this. So this is a good indicator, regardless of what you're trading. You want to be watching volatility and watching the VIX, especially as a beginner. You have to watch the VIX and see where it's at before you start your trading day. See what the range has been over the last week, so you get an understanding. You have your finger on the pulse of the market. And when people are reacting to news, you can look at the VIX and you can say, "Oh, okay, you guys are a little maybe overreacting, or maybe you guys aren't reacting enough because the VIX is giving me a different message, and you guys are seeming pretty chill right now. Maybe I need to, get hedged or get in certain positions now before this volatility kicks up or the market starts reacting to it." All right. So high volatility conditions. What you want to do when options become more expensive, selling premiums become more attractive. So we talked about how selling premiums in those debit spreads and credit spreads allows you to collect money on selling contracts and collecting the money at expiration. All right. So these are, like I said, the credit spreads, covered calls are good to do in this environment. Cash secured puts are good strategies to implement in this environment. And the iron condors, because these are all things that allow you to collect premium once the contract expires. So in high volatility markets, a lot of the times people do not know exactly where the stock is going to expire at. So as long as you can identify the range of that volatility of where it's holding support or holding resistance at, then you could just trade within that. You could just put your contract and secured call in that range so you don't get stopped out, and let everybody else trade within that volatility that's happening within that range. Let everybody else get chopped up worrying about if it's going to break above resistance or below support, or if it's going to break outside of this wide range of volatility, or if it's going to be volatile. You could just keep, like I said, put that collar trade on and make money on the wild swings in either directions. And you don't care what's happening as long as it remains volatile, you're going to make money. And that is done by a lot of the times not by just buying contracts, it's done by collecting premium on selling contracts. Let's go through the decision tree here. Before you make any decision or any trade, you need to ask yourself these questions, these 4 questions. All right, you have 4 market conditions, 4 questions. 4 is a good theme for this lesson plan right here. Remember the number 4. And you have, the question is, do I believe the stock price goes up, down, sideways, or do I believe, no, that's the 3 conditions. Or I would say this 4th thing I would say is, if you believe it's going to be volatile, do I believe we're in a volatile market? That would be the question I would ask myself as well, in that up, down, sideways, or am I in a very volatile situation? Question number 2, how strong is my conviction? When you see these conditions, how strong and how confident are you in the pattern that you're seeing? Do you have enough support? How many different areas of support do you have? Do you have support with the price levels? Is it supporting you with the pattern? Is it showing you the higher highs and higher lows? Are you doing this as a guess off of one of those and not multiple? So the more things that you can stack on top of each other to give you that confirmation in terms of price levels, in terms of trends, in terms of moving average, in terms of volume. And the more of these confirmations you can stack on top of each other, the better in the stock market, because that gets you further and further out the range of just guessing and gambling. And we're not here to guess and gamble. We want to make educated investments and trades, all right? We're not here to lose money. We're here to make money. So if you have slight conviction on a trade, a lot of the times I'll tell people don't take that trade. I will only take my trades that I have medium to very strong conviction on, and apply the strategies that will go for that particular pattern that is showing me. All right. Even if it's my very strong conviction is that it's going to the upside, if it's showing me a downside pattern, I'm going to say, you know what? I just know that this is showing me this move. I'm going to go with a move in this stock. I know a move is coming in this stock. Maybe I believe it's going up, but if it's showing me a downside pattern, I'm going to go with that move. All right. Especially if I have enough evidence to stack up and show me that that's the pattern. You gotta tuck your ego and pride aside a lot of the times in the stock market, all right? Question number 3, volatility. You gotta ask yourself, is volatility high? Is it normal? Is it low? So you could know normal volatility. Normal volatility, you could see within a stock what the average implied volatility is. You'll see that as IV in a lot of stocks. You'll see IV implied volatility. So this is the, you can see the average implied volatility on the stock, and then you can see the implied volatility for the day. So if that implied volatility for the day is much higher or much lower than the average, then you know the condition for that particular stock. And you can do that with the ETFs as well. So you have a baseline out there. All the information you need in the stock market is out there. You don't. There's really no secrets. So when people are telling you that you have to pay to get this information, that information, it's only because they know where to get information and you do not. But all the information is usually out there for you to take advantage of, and you just have to be able to put the pieces of the puzzle together. Last question I want you to ask, and this is a crucial question. This is about time. How much time do I expect this move to take? Is this a move that's going to take days? Is this a trade that's going to take weeks? Or is it going to take months? Or is it a year trade? Or maybe a 2-year trade, a leap? You know, so you got to know these 4 answers before you enter any trade. All right, so you're looking at volatility, you're looking at time, you're looking at what the direction you believe the stock is going to go in. You have to ask yourself all those questions before you enter a trade. Do not enter a trade without asking yourself those questions, and then you need to compound the confirmations after you ask yourself, after you answer those questions. All right, so here's a scenario. Let's do a walkthrough scenario. I'm gonna use NVIDIA, and let's say NVIDIA is trending higher, right? The support is holding on NVIDIA. The implied volatility is low. That's what IV mean. IV is implied volatility. The expected move, what you expect. Let's say we expect a 5 to 8% move in NVIDIA, which is a pretty moderate move. Okay? What strategy would you choose? I want you guys to think about it after what we just learned. What strategy would you choose for a move like this? You're seeing NVIDIA, support is holding, implied volatility low. You're expecting a 5 to 8% move in the stock. And it's trending higher. So this is obviously a 5 to 8% move to the upside. What strategy are you going to choose here? So the professional thought process in this case is, I expect moderate upside. Yes, great. It's not explosive upside, but I expect moderate upside, 5 to 8%. Explosive upside would be over 10% to me. Anything over 10% is a pretty explosive move in the stock market. So moderate upside, not explosive, not sideways. I don't expect chop, but moderate. So you know what? What's the best strategy? Now that I gave you these, what do you think the best strategy is? If you are saying long calls, no. If you are saying credit spread, no. Bull call spread, yes. All right. So it is one of the spreads, but it's the bull call spread. So you want to make sure when you do the spread, you want to make sure it's the one that is most applicable to what you believe the market's going to do. And Robinhood has this little cool thing when you go to the option strategies. You could go to bullish or bearish, however you're feeling, and it'll give you the different strategies for the different conditions. And now that you know the different conditions and what strategy to choose, you'll know which one you need to choose based on the bearish and bullish conditions that we're in, or sideways condition. All right, so that's the little tool that you could use in the option for my option traders on Robinhood. On other platforms, they do have all the different conditions on there, but it's not going to tell you if it's a bullish or bearish. You kind of have to know what each one of those trades do. But on Robinhood, it gives you that. If you can, we all have AI now. You could just go online, or you could take a screenshot of what I've given you here, that matrix that I gave you, and use that to help you guide you to pick what strategy you need to choose. So the bull call spread is that option. The market will choose the best strategy for you. Remember, tuck your pride aside. The market does not have time for you to be prideful. You need to be diligent. You need to be honest with yourself. The market will force you to be honest, and you need to be swift in your decision making, or else you will end up losing money. The market rewards speed. when you're option trading and rewards patience. I know it sounds like a paradox or oxymoron, but it's true. The market rewards speed and patience. You have to know what kind of situation you're in, where you're going to be rewarded for patience or speed. If you're option trading and you're doing contracts that expire within a month or within a week, within even 3 months, you're most likely going to be more rewarded for speed than patience because you're already on a timeline of expiration of 3 months or 1 month or 1 week. So you're being rewarded with speed. If you're a 0 day trader, your trade is all about speed. Okay, so as soon as you see profits, you're taking profits because you don't have time to let a trade run for too long because it could lose profits very quickly. So the longer out you go, the more about patience you are, the shorter your contract and timeline is, the more about speed you have to be when it comes to taking your profits. Okay, because we're on this to take profits. This is not about just watching our money go up and down all day. You want to take your profits. You want to know when to take profit and when to put money in the market and when to take profit and when to put and repeat that cycle over and over so you can derive income from the market while building wealth through your long-term investments. Okay, let's give another example. SPY has traded between two prices for 2 weeks. Implied volatility is elevated. No major news is out. What strategy would you use? So in this case, it looks like the market is pretty much chopping between a range. Implied volatility is elevated, so it's high vol, really pretty volatile, causing that chop in the range, which means it's probably trading high between high and low prices. No major news has come out on it to tell you which direction you may want to favor. What strategy would you choose? So this is how a professional would think. A professional thinks, I expect nothing to happen, right? Best strategy for you guys right now is the Iron Condor. We spoke about that in our last class, the Iron Condor, the sideways strategy. When you expect the market to go sideways, you're going to be in an Iron Condor, okay? So the Iron Condor is going to tell you um, that you're making money as long as it stays within that range. You're going to keep collecting premium every time it hits expiration. So if you're trading an Iron Condor that expires every week on Friday, as long as the stock doesn't break above that range or close below that range that has been trading in that you identified, you're going to collect your profits. You're going to collect your profits. And you could do that until you see the range start to break in one direction or the other. Let's get another example in. Example 3. Let's say Tesla is reporting earnings tomorrow. We had a Tesla earnings report coming out. Tesla's already volatile. Expected move 12%. Like I said, anything over 10% is going to be expected as high volatility. Direction, nobody knows. As in most earnings reports, people are going to say, oh, I believe it's going to go down. I believe it's going to go up. Nobody really knows where a stock is going to go pre-earnings. So don't let anybody convince you that they know or tell you that it's 100% guaranteed the stock is going to jump after earnings or drop after earnings. Nobody knows. So professional, how do we think in this scenarios? I don't know direction, but I know the movement will be huge. All right. So I don't know if it's going to go up. I don't know if it's going to go down, but I know it's going to go in one of those directions over 10%. So I could put it in positions to profit from that. Okay. Current strategies for you guys? None, because you guys don't understand how to implement a straddle, strangle, or a collar trade yet. But I will teach you how to do that. The strategies will be in the next lesson. So make sure you tune in for lesson 11 so you figure out how to make money in this type of scenario. But you can make money in this scenario. There's a way to make money in all scenarios. The assignment for this week, I'm going to say, there we go. I want you to find 5 stocks to analyze. I want you to take each stock and I want you to determine the trend that it's in, uptrend, downtrend, sideways consolidation. I want you to see the volatility. I want you to look at its implied volatility over the last week and its average implied volatility. See if it's being extra volatile now or if it's low volatility. I want you to decide what you expect the direction of the stock is going to be over this next month. And then I want you to say what strategy you would choose. I want you to put that strategy into into play. If you're going to do that via paper trade, I want you to do that via paper trade and see how that strategy will work out for you. Do not take any actual trade, but I want you to start understanding that this is how you need to look at the market. I want you to understand that you need to look at the market and let it dictate to you what needs to be done. And I'm trying to put you in a position where you have the tools for any type of market condition, where there's not a market condition where you're like, oh man, I got to sit this out. I can't make any money in this. This is terrible. Every market condition is a condition you can make money in, is a condition that you could find a strategy for. You could find a stock that fits that condition over a long period of time that fits a particular strategy, and you can repeat that, wash, rinse, and repeat that strategy with those particular stocks, because they are always in those same conditions. There are stocks that are always volatile. There are stocks that are always going sideways. There are stocks that are continuously in the uptrend. There are stocks that seem to be in a continuous downtrend. You could identify those and you could apply the strategies to those, instead of putting yourself out there with 100% risk, with naked calls, naked puts, or just being out there not knowing how to make money on a stock when it's going sideways. You're not going to be that guy or that lady anymore. You're going to know how to make money in all market conditions because you were here in Culture Shock University and you learned the strategies and you're going to implement them, and you're going to study, and you're going to make sure you are testing and back testing and seeing how these will play out for you, because the only way you're going to make money is to put in the work. Okay, it's not going to magically appear in your account. You're going to have to put in the work if you want to really make money doing trading in the market, because that's why you're here for this class. This is option trading. If you just want to do long-term investing, then that's a different kind of approach you need to take to the market. But if you're trading, you need to be putting in these reps and understanding these different strategies, so you know how to hedge and give yourself insurance in different market conditions, so you're not out there running around uh, naked with oil on you and people are shooting fire arrows. That's what it seems like when you're doing naked calls and puts. The market is not a safe place. Okay, so don't come in there with a perception that is all good and it's fairy tales. I mean, daisies and roses everywhere in the stock market. That's not the environment of the stock market. The market provides you massive opportunity, but is very, very threatening and risky if you do not understand what is going on. And it will take everything from you without any mercy. Okay? So make sure you are locked in. Make sure you do the assignment. I want you to learn to think like a strategist. And always, as always, tap in with us, Culture Shock Investments, on all platforms. TikTok for weekly stock lessons. We do our charting sessions. It's moved to Monday now. I got to change that to Monday. On Monday, charting sessions, and we do live sessions throughout the week on TikTok, as long as they're not shadow banning us for whatever reason. But YouTube, we do free trading tips, occasional live sessions on YouTube, and I'll repost a lot of the classes and long form content on there. And Discord is really where you want to be for access to all of the courses, my price levels that I post weekly. I give out a price level chart to give people guidance and make it as easy as possible on the stocks we identify to hold the best opportunities that week and or that month going forward, or giving people opportunities for leap trades, short trades. I try to give a condition that's out there for everybody, because not everybody likes trading the same conditions, and not everybody has the capital to trade all different conditions. Okay, so in my community, I try to cater to everybody and give you all the opportunity to make money, because that's the goal here, for us to build wealth together as a community and continue to support each other and grow. So there's no pride, no ego. Everybody in the community, each one teach one. Everybody is helpful. But if you have any questions that you're really unsure about, you definitely come to me. I will make sure I get you that answer, and we will continue to grow as a Culture Shock community. All right. I will see you all next week. Thank you for joining, and share, like, follow, repost. Definitely do that.